and welcome to the CNBC TV 18 special, The $1 Million Baby. The baby in question is the mutual fund of Motilal Oswal, and that baby is now $1 billion in assets under management. I have with me the parents of this $1 billion baby, Mr. Raamdeo Agrawal, and of course the two senior fund managers, vice president and fund managers of this fund, Taher Badshah and Manish Sonthalia. Gentlemen, thank you very much for joining me. To start with you, Raamdeo, I'll come to your fund in just a bit. But what did this earnings season tell you? Is the economy recovering at a micro level? Did more companies tell you that they sold more? Did the Imamis, Daburs tell you they sold more sachets? Did the power equipment or capital goods guys tell you that they sold more volume, not revenue?
I don't think that's the story. I think this quarter's, of course, we were expecting some surprise in the earnings side, but I'm really surprised by the extent of margin expansion because of the collapse of the commodity prices, oil and a lot of soft commodity, hard commodities which have fallen, and the pricing power has been fully used by the companies, starting with Maruti, your Britannia, your Pidilite and Asian Paints, you name it. All the companies which had pricing power, their margin EBITDA expansion has been almost 400 to 500 bips, which is staggering. On a 12-13% kind of business, you go to 18%. It's like a 50% expansion on it. Then you don't care whether top line is growing or not.
Absolutely.
You know, so that's a kind of and it is not the lowest oil price. Still, I mean, after the results,
they've fallen further.
They've fallen further. So I think for next 2-3 quarters, September, December, I think for the whole year, I think this segment is really going to do very well.
But Raamdeo, isn't this a risk as well? Because if the top line doesn't grow, then this is a bit of a one-trick pony, right? I mean, if for some reason...
We are talking about right now. Right now, the situation. See, this is all dynamic situation. Economy is recovering. Government has started spending. They are spending to the extent they can spend. So clearly, I am hearing some green shoots from the automotive markets and all. But it has not become very strong. But I am quite sure as the cumulative build-up of the government expenditure happens, this is 3 months, 6 months, 9 months, and then the revenue pick up. Because it's a circular kind of thing. You spend more, you get more revenue, you spend even more.
Okay.
So
no, actually, I wanted to take Anuj's question further. I mean, should not fund managers now stop worrying about top line and worry more about volume of sales? Because there is a secular fall in the realization, in the price. But that doesn't mean the company is not making money. They are able to cut prices probably because they are buying their inputs much cheaper. So as fund managers or even as stock pickers, is top line going to be ignored and you will look at volume and margins?
No, nothing will be ignored.
Okay.
I mean, fund manager is going to look at in a specific company everything. In the sense that company, if it is a cyclical company.
No. Are you going to be put off just because revenue is like 5%, but volumes and margins are making up?
No. It's individual stock. I mean, every company has a different story. Say a company called Britannia and all. So they have expanded the margins. They've got the volume. They've got the sales. Everything going. I mean, good volume, good top line, and terrific margin expansion. So you can get all types of colors of the companies. But if it is associated with the volume growth, pricing growth, and margin expansion, that's the dream run. That's the dream run. So. Volume expansion, but there will be a lot of companies where there is no margin right now. But your volume is going to just explode. So all kinds of stories will come. So this is opportune time, and it's all going to happen in next 6 months, 6 to 8 months. New stories are going to just start.
Indeed, in fact, Britannia is up 200% in last 1 year, as Raamdeo pointed out. Almost everything going in its favor. Taher, so $1 billion in your funds. What's the next target? We say that $1 billion is a lot, but given the kind of equity culture that's now beginning to take place in India, anecdotal evidence of a lot of gold investments, real estate investments shifting into equities, what kind of domestic flows do you think can come into equity markets?
So yeah, it's a great time. I mean, this whole rotation in asset classes is clearly going to be beneficial to equities, and we are significantly underinvested in equities from a household perspective, as we all know, running into single digits in terms of exposure. So there is always a lot of headroom which was available, and the market has probably started to realize that opportunity in front of them now with the new configuration of the government as well as the whole economic configuration that we have right now. So I think the future is clearly exciting. I mean, if you look at the statistics on mutual funds itself, I mean, we've got a flow of $4-5 billion in the last 12 months, and we've got an equal amount in the last 10 years. So, that's a staggering number, and we are still significantly below what we can probably be in terms of potential. So I think the headroom is enormous, and many of the mutual funds are getting into shape. They're getting up very well. Performances are improving. So I think we'll see a lot of action as far as domestic mutual funds. I hope we come to a stage where our dependence on FIIs and talk about daily flows based on FI numbers, etc., probably becomes much more muted going forward than we have been in the past.
Okay. Well, I'm trying to come to the stock-specific lessons that you all got from the first 1 billion. Let me start with you, Manish. The big powerhouse, or at least one of the big powerhouses in the last few weeks have been public sector banks. I've gone through all your lists. Barring State Bank, there's nothing. You don't buy this idea?
Look, there's a lot of problem in the public sector banks.
Yes, of course. But I thought buying in distress was what the market is doing.
But is it the end of distress? That is the moot question. The government has announced that 70,000 crores would be infused over a period of next 4-5 years. But is the problem not much more than what this 70,000 crore would do? Of course, it would alleviate a bit of the position, the stress position, but size of the NPAs is just too big, and within the PSU banks, a lot of NPAs, according to me, is still hiding within the restructuring thing, right? So
now it's not very financing as well.
So do you play valuation, or do you play the earnings growth, what sort of an earnings growth is going to play out over the next 3, 4, 5 years.
So not your cup at all.
I really don't think that we are at the end of the NPA cycle this year.
There was a grin on Raamdeo's face when we spoke about PSU banks, and I remember the central bank story that Raamdeo told us. But Raamdeo, that apart, you made a lot of money in some of these so-called high-price stocks, whether it's Eicher Motors, Page Industries, Bosch, Bajaj Finance. Some of these stocks are stocks where retail investors would not want to venture because, optically the price is too high. There's a bit of a scarcity premium in some of these stocks, but valuation-wise, these are very expensive stocks now. How do you justify some of these stocks as value picker now?
Taher has picked up all the stocks.
But why would you want to sit on? Are you not tempted to book out?
Not really. We have done a little bit of rationalization wherever we felt that the growth is significantly less than what the valuations are actually calling out today for. But then there have been many others, despite the run and probably despite stretch valuations in the near term, have a lot of headroom for growth.
So what is the number that you look for? PEG? How would you decide Eicher is too expensive or Bosch is too expensive?
Yeah, I mean, if there's a stock, let's say at 50 PE, and probably it is still good enough for a growth of around 30-40%, at least visible growth over the next 7 to 8 quarters, then that's something which is reasonably, we know that there could be a downside. We could probably see 5-10% come off. But we know that the underlying growth is supportive of higher valuations in general. But if there is a dichotomy to the extent that there is a stock which is trading at 90p and probably growth is more like 10%, then that's something which is going a little over the top. So there you would probably feel the need to rationalize and maybe try and see if you can correct that position, despite the longer term franchise attractiveness of the franchise of that business.
Just to add out here, without taking specific names, you take a weighted P of the portfolio per se, and then the earnings growth, the ROE, and there's nothing to say that we should only be looking at FY17 numbers. Markets are fixated about FY17. It is, the valuations are expensive. But business of the company would continue even beyond FY17, right? And we are nobody to tell to the markets what they should be looking at.
So are you convinced by the business models that this kind of earnings growth that we have seen as the base goes higher, that kind of earnings growth will continue?
That's what it is. Stock prices are nothing but evaluating what is the earnings growth and what is the longevity of the earnings growth. That is, if you get both these things right, it's a matter of time when markets get it wrong as far as the longevity of the earnings growth is concerned.
So you will not trade HDFC Bank for some of the new private sector banks?
Absolutely not.
Why not, sir? Why not?
He said no, longevity of the growth. See, one is the QGLP. I think this is...
Because I guess you're going to get a lot of private sector banks now.
So we'll be open to it. I mean, at a price.
I guess the Ratnakars and all also will get
so we'll definitely look
and you also have IDFC. And
we will have, we are open to any company which makes
shows
money.
Longevity.
Yeah, longevity company is high quality business, high quality management, growth, longevity growth, not 8 quarters growth. I mean, like 8 years, 10 years, 15 years, 20 years.
By the time the company proves it, it's also become expensive. How would you guess the longevity before you get it?
That's an art, no?
Yes.
That's an art, and that we are practicing.
Give us some lessons.
No, but lessons in the sense that, see, I'm telling you the factors we look at it. Every single company has to pass through QGLP process. Okay? Quality of business, quality of management. If both are not 10x each, it doesn't go through. We don't look at price. You all start with the price. See, the biggest problem in the market, in my opinion, is that people do valuation without understanding the values. Okay? So QGL is about the values. If you don't know the value, there is no point in looking at the price. If you don't know this is banana, how do you figure out what should be the price? You know?
Fair enough.
So I think we are spending 90% time, 95% time understanding the value. And once we know the value, then price is very easy. And you know, everybody's own money is also stuck with this. So it's not that we are speculating. We are investing. Seriously, we are investing.
Okay, let's hang on to that thought. We have to take a break. We'll be back with more questions to the team from Motilal Oswal on our special show, The $1 Billion Baby.